Welcome to the Market Pulse podcast. I'm your host, Dave Soika, member of the Equifax Risk Advisors team. This group identifies economic considerations and leverages data and analytics to translate into industry insights and recommendations. Ultimately, to support our clients during economic uncertainty while uncovering growth opportunities in consumer credit risk. I'm pleased to welcome back our panel of experts in the Risk Advisors group, Jesse Harden, Tom O'Neill, Thomas Aliff, and Maria Urtube. Welcome all.
Hey there, David.
Hey, Dave.
Hey, Dave.
How's it going?
Good. So I'm doing well. Thanks a lot. We've officially moved into fall, and Chicago temperatures are cooling off. And I think the pressing question for our audience is: have you started putting up your Halloween decorations yet?
And close.
Yeah, earlier this week, I was celebrating my birthday with my kids, and we were driving past some houses, and they were getting excited about all the decorations going up. And they said, we need to decorate our house for the holidays. And I said, you mean Halloween? We've got all the stuff. We can go to Halloween stores, or whatever. And they said, no, we want to decorate our house as a holiday house for Halloween. So they want to put up all the outdoor decorations like Christmas lights and whatnot for Halloween, but then take them down after Halloween and then reset them up again later this year.
So, Tom, when they say a holiday house, does that mean like a little bit of every holiday? So you've got every holiday represented for one day?
I think they were just going very meta with the costuming.
Sounds like a lot of work. But Dave, here in DC, there's enough scary things wandering around the streets, and I don't have to do anything. People are worried enough.
Some of them may even be weird.
Yeah.
Some of them? We just left our decorations up, Dave, from last year.
Yeah,
we're that
we put
family.
ours up last weekend. We've got a bunch of inflatable ghosts and skeletons and stuff. So we are very festive for Halloween. Now it's just time to buy the candy. But before we begin, let's hear from Moody's Analytics for a quick economic update.
Hi, I'm Shandor, an economist with Moody's Analytics. Let me give you a quick outlook on the U.S. economy. So in September, the U.S. labor market showed unexpected strength with payroll gains of 254,000, about 100,000 more than expected, and the largest increase since March. Revisions to the past 2 months also boosted growth, raising the 3-month average to 186,000, up from 116,000 in August. Unemployment rate edged down, the second consecutive monthly decline. Job gains have outpaced labor force growth, which is contributing to this drop. Healthcare and leisure and hospitality led the way, contributing 150,000 jobs, while manufacturing and transportation lost 16,000 jobs. Relatively strong wage gains of 4% year over year have been offset by robust productivity growth. So this mitigates some of those concerns about wages accelerating inflation. This will allow the Federal Reserve to continue easing monetary policy without fear of overheating the economy. Now, credit growth is slowing, with the expansion in balances expected to drop from 4.5% in 2023 to 1.9% in 2024. Delinquency rates are rising, but should stabilize just north of pre-pandemic levels by 2025. Consumer credit balances dipped slightly from August to September, and year-over-year growth slowed to 1.5%. Auto delinquencies are one weak spot. They've reached their highest rate since 2010. Now, risks to the outlook have balanced out. So on the downside, prolonged high rates still threaten to soften the labor market too much, while the upside includes faster productivity growth and stronger population gains, boosting labor supply. So the Federal Reserve is expected to cut rates gradually, likely reducing the November rate cut from 50 to 25 basis points, and we expect 25 basis point cut in December and in each quarter of 2025. Thank you so much.
Thank you. Today's topic will be the impact of the Fed rate cut in September. The U.S. economy has been dealing with relatively high interest rates for the better part of 2 years. Inflation, uncertainty, and an upcoming presidential election have been weighing on the minds of the average American. With the recent 50 basis point cut to the federal funds rate announced on September 18th, we will look into the impact this will have across the U.S. financial system. Starting off with the economy and then the Fed, Next over to U.S. households, lenders, and then finally ending with the U.S. government. This 50 basis point cut lowers the FOMC target rate to between 475 and 500 basis points. So, Jesse, looking at the economy, the lone dissenter from the Fed board worries that we are spiking the football before we cross the goal line. Then yesterday, October 3rd, Federal Reserve Bank of Chicago President Austin Goolsbee emphasized the need for substantial interest rate reductions during the next year. Isn't this confusing?
Confusing, yes, I would say so. I would say though that there's always confusion in our economic direction, and I think that has a lot to do with the amount of data that gets reported, and then the interpretation of that data. So I think everybody has insight and everybody has experiences that kind of dictate what they feel like the data tells them. I've heard some doubters talk this week about whether we're spiking the ball too soon. It seems like some of those worries have died down as we've seen better inflation data, but then also some of the data that we get out of the labor market. Honestly, I feel like we always need something to worry about, so we've got no shortage there. Your football metaphor made me think of a something though. I was watching Forrest Gump the other day, and if you recall, he was a running back at Alabama, and basically started running down the field, and he's running down the field and then runs sideways and then maybe backwards and then forwards. It almost feels like that's a little bit like our economy right now as he runs through the end zone. And by that, I mean, we're heading in the right direction. We see the coaches kind of pushing us, different ways. But I think we're moving ultimately in the right direction. And I think the Fed's clearly signaling that with the cuts. They're focusing on the dual mandate, not just keeping inflation in check, but now watching the labor market and the stability in the labor market as well.
Great. Thanks, Jesse, on that point. And obviously, the big goal for the Fed has always been that 2% target rate. So have we reached it yet?
Yeah, I think so. I think we have. And I think the Fed is indicating that as well. So the Fed looks at the personal consumption expenditures index. It's called the PCE. The markets tend to watch the CPI, which is the consumer price index. In both of those calculations, we see a 2 in front of that number. So I think materially we're there. The PCE has probably been closer to the Fed's target for the last couple of quarters now. And if you look at CPI, we see that economists kind of take things out of the CPI. And if you take, for example, if you take owner's equivalent rent out of the CPI, you really get to that 2% number that they're looking for. I mentioned that the Fed is clearly focused on this dual mandate, this idea that they want labor markets at equilibrium and also inflation at equilibrium. And so I think the Fed's guidance is telling us that they're shifting focus away from inflation and really focusing more on the labor market stability and some of the longer term rate implications of policy. They're also saying that I think if you read kind of between the lines, they're saying that the longer rate policy for longer is probably not the direction that we're going to be headed into. And so I think you can see that. You can certainly see that in some of the comments that Chairman Powell has made recently. So really, we're seeing that the Fed is signaling, and the economy, I think, is expecting that inflation has probably cooled enough where we're not going to be, we're not going to be materially talking about inflation moving forward.
Great. That's thanks a lot for that insight, Jesse. Kind of shifting over now to the U.S. consumer, and there are several areas where that rate cut should have an impact. And Maria, we'll start off with you looking at households. So we recently got the Consumer Confidence Index release, and that fell from 105.6 in August down to 98.7 in September. As we start digging into the impact, let's focus on consumer sentiment. So what is it, and why should our audience be interested in how households are feeling?
This index, Dave, is produced monthly by the Conference Board and measures how optimistic or pessimistic consumers are about the overall economy. And it is based on their personal financial situation, the labor market conditions, and the general economic expectations. It's a numerical value where 100 is the baseline representing that sentiment in 1985 when consumer confidence was considered stable. An index above that 100 indicates consumers are more optimistic than that baseline year. Below signals that consumers are less so. And this matters because consumer sentiment drives spending, which accounts for about 70% of the GDP in the US. The drop we experienced, the largest since August of 21, indicates a significant decline in consumer confidence, attributed to concerns about the labor market and the job security. And as you've been noting, Dave, there is cautious optimism. So even with the rate cuts, consumers may hold back on major financial decisions.
Right. Yeah. And on that, obviously, one of those financial decisions is the budgeting, kind of where they're spending or what they're saving. So, does this make them feel better about their current financial situation enough to have them spend, and even kind of what they spend on, and is it enough?
Yes, this 0.5% rate cut generally benefits household budgets by reducing debt costs and freeing up disposable income. However, the extent to which it improves the finances for household will depend on factors like the type of loans that are held, the debt levels, and whether inflation remains under control. Going back to what Jesse was making reference. And the biggest impact of the rate cuts will be felt by borrowers with variable rate credit, such as variable rate credit cards, adjustable rate mortgages, and home equity lines of credit. Those with fixed rate loans will only be affected when new loans are issued or when they refinance. And on the other hand, the rate cuts lower the return on savings products, so making them makes them, of course, less attractive. And households that rely on interest from savings accounts or CDs will see returns shrink as a result of these lower interest rates.
Great, thank you. Tom, building on Maria's comments, as household sentiments move, what might the impact be to the housing market? Rates have been significantly higher than they were before the pandemic, and we're still dealing with a shortage of available houses for sale. We'll break this question on housing down into first mortgages and then kind of look at home equity and HELOC loans. So on the housing side, does this move the needle enough to see the mortgage market move in a consistent direction?
Well, it certainly helps. Whether or not it actually moves the needle or not, that's a different question. But keep in mind that unlike other types of lending, mortgage rates aren't necessarily, well, they aren't directly tied to the rates that the Fed just cut. And in fact, the mortgage market had already priced in some expectation of rates coming down, and we've been seeing the mortgage rates come down even before the Fed took their action recently. And so while any decrease in mortgage rates will help, there are also several other factors that play into this as well. Yeah, obviously the price of housing itself still remains, well out of reach of many, even before factoring the costs of borrowing. And another factor is that, a lot of homeowners who are currently locked into some very low rates that they locked in when rates were super low a few years ago. They're still probably going to need to see current rates come down significantly, before they're willing to give those low rates up and go back out on the market for a new home. So again, any decrease in the cost of borrowing and the overall price of home ownership will certainly help, but it may be more of a trickle, than a flood for a little while, unless we make progress and see, reach some threshold that no one, really knows, what that threshold would be yet.
Yeah, that's some great insight on the purchase market, Tom. So what about the refi market?
Yeah, now that's something that we may actually see, some more immediate movement in, or I think that we may see it, for that matter. Um, we all know that the housing market's been slow the past few years, but it hasn't been at a standstill. People have still needed to buy houses, and obviously they've had to take the mortgage rates that are out there, which, obviously have been high. So there's probably going to be some excitement to take advantage of some of the lower rates that we hope to see over the coming months. But the interesting thing is going to be to see how people balance that immediate need for relief with playing out the market. If consumers feel that rates are going to continue to move downwards through 2025, they may be willing to hold off on that refi until they see rates come down even further. And of course, you're going to have people who either want or need to get that immediate relief to their monthly expenses as soon as possible. So I think we will see some similar trends, in the refi and the mortgage, first mortgage, markets as we go through 2025 in terms of both of them picking up. But we may see the refi market running a bit earlier in those upward trends than the mortgage.
Great. So we've covered people purchasing a new home. We've covered people refinancing their debt. But what about those people who are in their homes today and then are looking to take either, a HELOC or home equity loan?
Yeah, borrowing on home equity. That's been interesting over the last few years. And this one is a bit different from the other two that we just covered. Yeah, because even what we've seen over the last few years, even as rates have risen in home equity borrowing, it's still remained a pretty popular borrowing option compared to other options, that consumers have had, for the types of things that people take out HE loans and HELOCs for. In fact, with while we've been seeing the rise in values of homes over the last few years, a lot of people have equity that make this possible that they didn't have before. So it's continued to be a pretty attractive option over the last few years, even as rates have gone up there. And in fact, while we've seen the first mortgage dollar originations, totals fall to about 2/3 of what they had been over the last few years. In that same time period, home equity loans have doubled in terms of their dollar originations. So I could see this market continue to sort of chug along, if decreasing rates, continue to make it an even more attractive option. But we probably won't see the kind of proportional growth that we hope to see in the mortgage market overall.
Okay, great. Maria, back to you. Another thing households worry about when they're spending is, how do I pay for those purchases, which oftentimes is on a credit card. So what impact will the rate cut have on credit card users?
Well, most credit card interest rates are tied to a benchmark rate, such as the prime rate, which closely follows the central bank's rate. So when the central bank cuts rates, the prime rate typically falls by the same amount. The primary beneficiaries of the 0.5 rate cut among credit card users are those who carry high balance, particularly those with variable rate credit cards, those who carry a balance month over month, the revolvers, the subprime borrowers who often face higher interest rates, and of course, users of higher interest cards like private label or retail cards. Borrowers that pay their balances in full, transactors, and any borrowers, card holders with fixed rate cards will see little to no direct benefit from this rate cut.
Thank you, Maria. Tom Aliff, I'd like to turn over to the auto market and ask about the impact here. The industry has been dealing with constraints for a better part of a year coming out of the pandemic. We've seen in the news about rising prices, significantly over the last 3 years or so. There's been the incentives from the captives to grease the wheels of purchasing. But since auto loans are installment, is there any expected relief here?
Yeah, so I think there's a number of factors that tie into the ability for a person to obtain a vehicle, the lending associated with that, as well as I guess car manufacturers or lenders to be able to offer that opportunity to people. I guess, for me, I've bucketed into a few categories. I know you mentioned things about incentives and whatnot, but the four categories that I would bucket it into are going to be things around economic conditions. And a lot of those things are going to be stuff that we talk about on a monthly basis, around consumer confidence, things that are, leading into that around what are the sentiments associated with these things? How does affordability look? And interest rates directly do tie into the affordability, because in the auto space, the key, categories for lending are going to be the credit score, payment to income, and loan to value. And payment to income is going to be what's the monthly payment that's needed for that that person, and then affordability ties in. Did they make a down payment or not, according to the to various levels of loan to value. So it all really depends on that person's individual profile on how directly correlated it will be to any change in interest rates. The second thing is around supply chain and things like that we've seen, or what's currently available, which both impacts the new and then subsequently used auto market. In the 2023 timeframe, we saw about 15.5 million new vehicle sales and 35.9 million used. And so those numbers vary depending on what becomes available, how much your vehicle's costing, and then ultimately can people afford them? And so then that then moves into some of the things that, like, what's occurring and what do people want, and do they have that? People in the United States, they love their cars. It seems our infrastructure and culture is very tightly bound to that in many regards. So things like electric vehicles, autonomous features, all the stuff that starting, like, what are the new things that come out, and is it enough for someone to to continue to want that new vehicle, along with the affordability that comes with some of the new vehicle costs, and then ultimately coming down into some form of people's preferences. And preferences are becoming more and more important. Like, are we going to shift more or less towards SUV trucks? And what about and some of their personal things around environmental impacts and sustainability and climate change, and what are the impacts that people are wanting to have according to that.
Great. So do you think the biggest impact will be, is it really going to divide between new and used, or do you think it's more on the captives versus everybody else? Where do you think that impact might be the biggest felt?
I think that's going to be hard to it's going to be hard to say. There's definitely, depending on where vehicle prices go. Like, if prices are higher, oftentimes the used market can have, like like we saw in the last few years, because supply wasn't there, but that drove used prices up. And so really just depends on how things are moving through that, and then depending on the total price of the vehicle is going to be directly correlated to the loan amounts, and then if we loan amount then is going to be directly tied to interest rates. So I think that all of those things tied together with affordability, consumer confidence, is going to drive, like, what's going to have the highest or lowest increase. And but there's also an opportunity now with the interest rate changes to size and understand, like, what's potentially going to happen with refinances, for example. And we have seen just interestingly enough, that large number of people just choosing to walk away from parts of their auto loans. And now it's a very small sector that's doing that, but there are people who are unable to make those payments in ways that we've not fully seen in the past before as well.
Right. That's an interesting note. I think that we may have to revisit in a future podcast. People walking away from autos. Tom O'Neill, back to you on this one. The next group we want to look at is the lending community, from banks and credit unions to finance companies and fintechs. What does the rate cut change in the mind of a financial institution? And we'll break this into a few parts: access to funding and credit lending standards. So in terms of lending and access to funding, have lenders been constrained in who they lend to and how much they're able to lend out due to the higher interest rates? And then does that suddenly change?
I love these two-parters, but to the first part, well, yeah, is the short answer. Anytime that you have a product, the product that you offer increases in price, which is the case that we're talking about when we're talking about lenders offering different forms of borrowing options to consumers, in a period when rates are going up. Yeah, anytime we have that, there's going to be a negative impact on the demand for that product. But on the flip side, as we all know, price isn't the only factor when it comes to consumption. So for example, while high interest rates, as Tom Aliff was just talking about, high interest rates and overall affordability have impacted areas like the auto market. Credit card originations hit a new high recently, and in fact, they hit, in terms of new lines being opened, they hit a high in the fall of 2023, just about when rates were at their all-time high point, or at their recent all-time high point. So yes, they've been constrained, but not as a blanket statement covering all lending activity. In terms of whether this suddenly changes, everything, no, not necessarily. I think Maria touched on a few items where, we will see immediate impact to some of those revolving rates. But as I mentioned before, other things like, rates for mortgages and other products, those are going to be slower to change. And so when we look at this and we think about what's the impact on all of these different lending markets in terms of growth opportunities, we have to realize that this is going to be, a longer term impact, and the changes in rates, are only one factor in those market dynamics. Mind you, it's an important factor, but it's just one factor.
Yeah, you touched on originations, and so obviously that's the next question is what's the impact on application volume as well as the number of new loans booked as a result of the rate cut? Might certain lending institutions handle things differently?
Oh, absolutely. Yeah, just because different institutions always do things differently. Um, yeah, when we are in a period of change, and we are in a period of changing interest rates environment, different lenders are going to take different approaches on how they handle that change. They may differ based upon, the consumer segments that they focus on, the local markets that they compete in, the different lending, products that they offer. There's a lot of variables in terms of how different, institutions are going to approach these changes, on top of just the natural, what is the culture and what is the risk and growth appetite of these institutions. And that's what a lot of it comes down to. There's always differences in terms of how they approach that dual mantra of growing, but managing risk at the same time. And obviously those are generally polar opposites of each other. Um, and I find it interesting that even, that when we do find ourselves in periods of change, like as we've seen in, recently when interest rates were coming up, and as we, head into this period of what we assume will be declining interest rates, there's always differences in the way that institutions, approach that. A lot of them want to be the first, the ones in front of taking advantages of the changing environments and getting a competitive foothold. And others are much more conservative. And as the pendulum swings, they prefer to take a wait and see approach and see how things play out. So yes, there will be differences in terms of how they approach these changes, but they will change. That part I'm pretty sure of.
Great point. So obviously, we've just covered the outflow of money from financial institutions, but now let's focus on the inflow, the deposits question.
Sure.
With lower rates, do financial institutions, what do those financial institutions do in regards to maintaining their targeted deposit levels?
Yeah, this is a very interesting area that I'm particularly interested to see how it plays out over the coming months and quarters. And it also, it's another factor in the answer I just gave around how different lenders approach things differently. So typically, we've seen lenders be quick to raise rates on their lending products when rates go up, and they're generally slower to raise their rates on savings and CDs and other functions like that, which makes sense. One is revenue, and the other one is an expense. And of course, when rates are coming down, the opposite tends to be true. Their lenders are typically quicker to lower those rates on savings accounts, CDs, and so forth. Now, however, we're in an interesting period where there is still a very competitive environment for savings, for having the reserves that lenders need to put whatever growth opportunities, or growth strategies they have in place. So I wouldn't be surprised if there's, more of a lag than historically we see in terms of lowering those interest rates. We saw recently when rates went up that consumers uh, showed very little hesitancy to shop around and move their money to where they got the highest return that they could find. So I wouldn't be surprised if we saw something similar on the backside of this as rates start coming down. So instead of lenders reaping the rewards of getting more depositors by being the first one to raise rates, It may be the opposite, where maybe they reap the rewards of being the last one to lower their rates, and see people, moving over to their deposits, to take advantage of this. So it'll be an interesting thing to see play out over the next couple quarters.
Great. Thanks, Tom. So let's put a pin, stopping point on our consumer side. Let's talk to Jesse, our de facto economic expert. I want to ask you some questions about how the U.S. government is it going to continue to navigate the path to a soft landing. The rate cuts have started. Inflation seems to be plateauing. We got good job numbers this morning. So, even as the average American is being concerned, as Maria had pointed out, around how sentiment moves things, the Fed's also aware of that. So they gave us a larger rate cut than expected. So what's next in terms of the economy? And let's start off with everybody's favorite subject, the federal deficit.
Yeah, that's a big topic to start with, Dave. I was trying to find a good joke about the federal deficit and I couldn't find one. So maybe that's the joke in and of itself. Obviously the deficit's concerning. It's continuing to grow. In the fiscal year of 2024, we're going to spend more on interest and defense spend, more on interest and or more on payments on interest in the government debt than we will on defense spending and some of the big non-discretionary categories. So certainly concerning. And I think we've kicked the can down the road for so long that it seems like, we just continue this, kind of this escalation of the impact that the debt has. It's going to take time. I think it's also going to take some pretty draconian austerity measures to pull us back. The commonality they say between the rich and the poor is that nobody likes taxes. So, it almost feels like there's something to kind of find fault with whatever happens. And I'd say probably more pressing now is even just the immediate future of the economy with some of the funding, the budget funding gaps that we have right now. So Congress is ultimately going to need to vote on a spending measure come December timeframe. We've passed, I think, 5 continuing resolutions now to continue spending in the economy. We've also got the Trump era tax cuts that are expected to be voted on in 2025, and those may look different than they look right now. So a lot of things kind of moving with respect to where the government's going in the direction of policy, and we'll have to kind of continue to watch that. By the way, we've got an election in November, so certainly something to consider there that may or may not help this direction. So I'd say, to answer your question about whether or not we hit that soft landing, it's probably whether or not you're a glass or half full or empty person. But in general, I'd say there are some things that have to be overcome in order to kind of hit that magic mark.
Right. And then my last question for you that is something that I think most Americans wouldn't consider having an impact directly on them is global conflict. And obviously we've heard a lot in the news. So kind of how does that impact us?
Yeah, I mean, we heard a lot in the news, that's for sure. And so I think people probably are more aware of it now than they've ever been. I'll tell you a funny story. I was actually listening to a podcast on Monday night, and it's a fellow economic podcast, Moody's Analytics. And after I listened to that podcast, I was so upbeat. They told me all the things that I was kind of thinking myself, and I'm like, God, this feels great. And then Tuesday morning rolls around, and I read about a strike, a dock worker strike, and I read about an attack between Iran and Israel. Really, just kind of shows you that it's so dependent upon what day you look at the news, what matters. And so I hate to feel like Debbie Downer now. There are some things that we're watching right now. You mentioned global conflicts. I can talk about those, but also there's some domestic stuff as well. So from a global standpoint, I would say that we are watching what's happening between Iran and Israel and the Middle East in general. Outside of the political aspect of that, probably more looking at what happens with oil prices. So with oil, we're at around let's call it 320 a gallon right now, or 320 a gallon for gas. that has a direct bearing on where Americans are in their livelihood. So if we see 350, we start to see some pressure. If we get into the $4 range, we really start to see pressure, and that's going to have a pronounced impact on the economy. So that's worth watching. Obviously, Russia, Ukraine, the escalation there, and that's a concern as well. I think some other things too. China, we're watching China. There's economic development there where we're seeing a slowdown in their economy, and obviously, whether we like it or not, there's a tie there between the Chinese and American economies, and so kind of watching how China's pumping up their stimulus on that side. And then I mentioned domestic, so the dock worker strike has fortunately kind of ebbed a little bit now. Where it was a bigger issue earlier in the week, it looks like the dock workers and the docks themselves have kind of come into an agreement, at least, to review this after the first of the year. So that's certainly a good thing. We don't want to see supply chains snarled like they were. We've seen other strikes as well. Boeing has a strike ongoing. I think there's other strikes. AT&T may have one. So certainly there's a movement there as well for a balance between labor and companies. And then that all of that is I think just kind of churning and probably wait and see in terms of how it fully impacts the economy. I like to think though of a quote by Jim Lovell, the astronaut that was on Apollo 13. And it's not the quote, Houston, we have a problem. It's actually one when they were trying to solve, I think, 100 different problems. He said, we're just going to have to tackle these problems one at a time. And so I think it's really pertinent right now when we think of everything that's coming through.
It's a great way to end the podcast, Jesse. Some comforting food for thought. So I'd like to thank Maria, Thomas, Tom, and Jesse for joining me today. To our listeners, I hope you enjoyed today's topic. And if you have questions or suggestions for future podcasts, please reach out to us at riskadvisors@equifax.com. Thank you.